I am really very quickly going to try and give an overview, a snapshot picture of capital flows that we've seen over the past year, the trends in real estate investment activity in European markets, as a backdrop then to focusing in more detail on the results of our investor intentions survey. If we just look at the big picture in terms of overall volumes of transactions in European markets over the recent past, in 2011, actually activity held up pretty well given all the turmoil and so forth that was happening in other financial markets at the time. And over the year as a whole, we saw on our reckoning 118 billion euros of deals concluded in European markets, which was 7% up on the previous year. We saw a significant flow within that total of what I would call long-range capital coming into Europe from other regions of the world, 19 billion euros in total, of which the largest share came from North America. Within Europe, you can see that that investment was very strongly focused on a limited number of cities, with the London market head and shoulders above others in terms of its share, around about a third of that total, which it attracted. Paris, as is usually the case, in second place, and then interestingly this year, two Russian cities in the top 5. Starting with the big picture question, what is the most attractive global region for you to make investment purchases this year? Well, not surprisingly, Europe, Western Europe and Central and Eastern Europe were very popular with our investors, given that most of them are domiciled in Europe. The only other perhaps significant point to note in this table, this chart comparing with last year, is that the popularity of Asia was down a little bit and the popularity of North America was up a little bit. Within Europe, what was the most attractive country or region for purchases in 2012? Here we see some interesting changes from last year, of which the most notable is that the UK has returned to top slot, with just over 30% of investors giving that its first choice, up from 16% last year, actually really moving back to where it was in 2010. The other most popular countries, markets, are Germany, which is down a bit from last year, Central and Eastern Europe, down a bit from last year. France also down, which is interesting after a very strong year in the market there, Spain down, the Nordics a little bit up in terms of popularity. When asked which was the individual most attractive city within Europe, we actually got from the respondents a very large number of cities in total were mentioned, over 30 I think, but actually only these 10 attracted more than 2 or 3% of the total, and there you can see London head and shoulders streaking ahead of any other city with a 37% of the vote. But interesting to find Warsaw in second place, ahead of some very much bigger markets further down the table. This, I think, interesting in terms of highlighting investor interest in the Central and Eastern European markets. Dublin, interestingly there, to find that in the top 10, not huge interest, but Dublin, a market which has been radically repriced, which may now perhaps investors seeing recovery potential, and perhaps Madrid also falling into that category. We asked, is the availability of debt finance affecting your investment activity? And overall, 43% of the sample of our investors said yes, it was. And that was for two reasons. Either that the terms on offer for them made borrowing uneconomic, or they could not borrow to buy the type of assets that they wanted. And it was particularly noticeable when we did the cross-tabulations that those investors who were interested in opportunistic or distressed assets were overrepresented among those who were constrained by debt. We asked again, as we asked last year, what investors perceived as the greatest threat to the recovery of the European property market. And again, an interesting pattern of responses here, with the answers clustering very much on 3 particular factors. In first place, the inability of investors to source new debt came out as the number 1 factor. About 28% of investors identified that, and clearly those who were facing debt constraints were disproportionately represented in that group. Then in second place, a double-dip economic recession, and slightly behind that, a breakup of the Eurozone. Interesting to compare this with last year, when in fact fears of a double-dip recession were much less, and in fact there was much more concern at that point 12 months ago, interestingly, with rising interest rates and inflation. How much can change in a year? Against that background that we've seen earlier, of caution, to some degree, of uncertainty, of these serious risks in the market, nonetheless, overall, the investors were very much biased towards maintaining or increasing their investment activity. So we asked about expected purchasing activity this year compared to last year, and over 80% said their purchasing activity will be the same or more than it was last year. Despite the risks and uncertainties in the market and degrees of caution, overall, investors are looking to commit more capital to European markets in 2012.